Okay, yeah. We
Just
use
say one
both,
minute.
sir.
Yes, Anshul sir, we can start, please.
Thank you, Dheeraj ji, and I welcome all the participants on this last day of Certificate of International Tax course. And we have the august presence of Charanjot Singh Nanda ji, the Central Council member from NIRC region. He has been there for us for all the time, and he has now today taken out time, even during his travel time. He is traveling from Punjab to Delhi, and during his travel time also he has taken out time to be with us and guide us. So we'll hear him also. But I welcome all the participants today, and I must say that this has been a truly international conference kind of a thing, because we had people joining in from Ahmedabad, Allahabad, Amritsar, Bangalore, Hyderabad, Bhopal, Chennai, Cochin, Dehradun, Faizabad, Faridabad, Delhi NCR is there, then Jaipur, Jamshedpur, Kota, Lucknow, Ludhiana, Mumbai, Osmanabad, Panchkula, Pune, Panipat, Roorkee, Thane, Tirupur, Udaipur, Vadodara, and Valsad. Means there are so many people joining in from so many different places, and we had, in fact, international participants also joining in from Doha and Nigeria. So this has been a wonderful, wonderful interaction with all the participants over past 3 days, and I hope that we will stay connected and stay in touch. I'll now hand over to Dheeraj ji for initiating the session today.
Thank you. Thanks a lot, Anshul sir. And really very rightly quoted by you that the participation from the members from corners of the country and even from outside India as well, it is making this conference, this particular program as an international program. So it became possible just because of the support from all the participants and all the team members. And really, we are very much pleased that today we have with us C.H. Charanjot Singh Nanda sir, who himself can be named as the person who is the mentor for many of the chartered accountants. And we are really thankful that if in any of the program which is being organized by Asian Economic Council or Let's Share or Chamber of Chartered Professionals, every time, whenever we request him, he is always available to guide the professional brothers and share his words of wisdom with us. We are really thankful to Nanda sir. Welcome you, sir. And also we are thankful to all the speakers who have taken out their time and shared their thoughts and experience with us during the entire course. Today is being the last day. Today we are going to discuss about section 195 and some practical issues relating to form 15 CA, 15 CB, which is being taken by our course director, Anshul Singhal sir itself. So before we move ahead, we would like to take this opportunity that in the august presence of Nanda sir, we would like to acknowledge the contribution by all our speakers and all the moderators. So I would like to share the screen to present the certificate of appreciation dedicated to all our worthy speakers. So with the permission of Nanda sir, I would like to move ahead, and it will be just like we are offering this certificate by the hands of Nanda sir itself. So in the first day, first session was taken by none other than C.A. Siddharth Sipani, who has covered the basics of the and all the overall structure of international taxation, structure of tax treaties, and he has shared the important terminologies relating to this. And it was started by him in a very wonderful manner. In the first day, we had the second session, which was taken by C.A. Sharad Goyal sir. Sharad Goyal ji covered about the residential status, and it was really very wonderful session where we have he has addressed many of the questions which have been raised by many of our participants. So he has covered about the tiebreaker rule and the determination of residential status and what are the practical issues while determining the residential status for the purpose of international taxation. Day 2, it was taken by
I
our
think
own course
one mention, Dheeraj ji, sorry. I think the
yes.
Sharad ji has joined, but he is not on the panel right now. He might be in the attendees. So we acknowledge the presence of Sharad ji today also.
Yes, sir, I am making him panelist as well. Welcome you, Shah sir. We really convey our thanks to you for your support and sharing your words of wisdom with us during the session. On second day, the session on permanent establishment was taken by the course director, Anshul Singhal sir. Yesterday, we had 2 sessions, and in the first session, the discussion about royalties, it was then made by our speaker, C. Gaurav Makhijani. He has covered about the definition, important issues relating to the calculation of royalty, what the computation of royalty, and what are the rules and rates which are applicable for the royalty payment, the taxation provisions on royalty, and also he has covered various case studies as well. So in a very excellent manner, he deliberated his entire session, entire thought and entire session, so that all the participants were able to learn a lot, and the questions asked by the participants were also answered during the session. Also, we would like to acknowledge the tremendous support of our course director, Anshul Singhal, in the capacity of the speaker, in the capacity of course director. So we are thankful to you, Anshul sir, for all your support. We had the moderator of the program, 3 moderators who has been with us during the entire program. They have coordinated for everything. C. Shikha Valecha from Palwal. We acknowledge the contribution by Shikha. Another moderator of the program, C. Akhil Girdhar from Faridabad. He has moderated the session and also coordinated the entire program. And the third moderator of the program, who is going to moderate today's session, Palak Shah from Vadodara. So while acknowledging all one of them, we would like to also acknowledge the support by say Vijay Kumar Gupta ji, President of Chamber of Chartered Professionals, and none other than our mentor, our guide, say Charanjot Singh Nanda sir, who is with us today. So sir, we also would like to acknowledge your support, and surely it will be great for us to learn a lot from your words of wisdom, as today we got this opportunity to hear you sir. So I would like to move ahead, and before we invite Charanjot Singh Nanda sir for his words of wisdom, I request Palak Shah from Vadodara, moderator of today's session, kindly introduce Nanda sir. Though I believe there are a lot of things to speak about Nanda sir, but a basic few things we really want to introduce about Nanda sir. Over to you, Palak, please.
Very rightly said. I also believe Nanda sir is the man who needs no introduction. But still, I'm very grateful to get an opportunity to introduce CACS Charanjot Singh Nanda. Nanda sir is currently the chairman of Internal Audit Standard Board and Committee on Management Accounting and the vice chairman of CPE Committee. He is a practicing chartered accountant since 1991 and is practicing in the fields of capital market, banking, human relation management, corporate laws, taxation, audit, etc. With the commitment to serve the profession, he has been a member of SEBI, Advisory on Primary Markets and Mutual Funds. He has also been a member of the SAFA Committee on Improvement in Transparency, Accountability and Governance, member of IRDA Steering Committee for Implementation of Risk-Based Capital Regime. As an avid speaker, he shares his knowledge in India and abroad at various events and platforms organized by the Institute of Chartered Accountants of India and other various reputed institutes all across the globe. With this, I welcome Nanda sir. Thank you so much for being here.
Thank you, Palak, for a wonderful introduction. My younger brother and founder of Devalia e-learning, CA Dheeraj Sharma, who is the former chairman of Gurgaon branch, the course director, a very enterprising, a very thought-provoking C. Anshul Singhal Sahab, Madam C. A. Shikha Valecha, C. A. Siddharth Sipani, and all participants have come here to go home more enlightened today afternoon. Ladies and gentlemen, I'm truly thrilled to be here amongst you. I'm truly honored. And I want to tell you that your institute, the Institute of Chartered Accountants of India, was set up an Act of Parliament way back on 1st July 1949, when the most important document to the democracy was not adopted. You are all aware that the constitution to this great country was adopted on 26 January 1950. The pertinent question that arises is, what prompted the Constituent Assembly to set up an Institute of Chartered Accountants of India when its own democratic setup was not in place? The answer is very candid, very simple, very forthcoming. They were looking for a disciplined band of soldiers to steer this country out of confusion. And here we are, with power-packed, knowledge-packed, technical sessions to hone our technical skills. I want to tell you, ladies and gentlemen, that our working is at the lightest ebb. This 1st July 2021, we finished 72 glorious years of this great profession, and We stepped into 73rd year, enterprising, very adventurous 73 years. And here I take this opportunity to tell you what an Indian chartered accountant is. If it has to be said by way of a couplet, the couplet will be, Zubaan kadwi hi sahi par saaf rakhta hu. Zubaan kadwi hi sahi par saaf rakhta hu. Kaun, kahan, kab badal gaya, sabka hisab rakhta hu. We are people who are transparent enough and yet accountable to ourselves also, so that we understand how things have to be put in the right perspective. 1st July Council took two very important decisions which I would like to share with you. The first decision, if unfortunately a student loses any of his single parent, he need not pay the course fee. This is for next 2 years. If unfortunately, accidentally somebody loses any parent in next 2 years, a student, they did not pay the course fee of ICI. Second thing, the second was a gift from Ministry of Corporate Affairs to us. On 1st July, management multidisciplinary partnership firms have been made a reality. That is the best part. Now, any practicing chartered accountant can partner with a company secretary, an ICWA, an architect, an MBA, an engineer, an advocate, any profession which has a regulator, they can come and work with that. So largely we are at a perspective where we start understanding what is our aim in terms of creating the value. In terms of creating the value, we have to work in tandem with the standards which are laid as best practices internationally. And I compliment this great session of today's, which is ultimately empowering chartered accountants to come into a very significant and unexplored area of international taxation. International taxation undoubtedly is an area where your professional impetus, your professional knowledge holds a lot of value. And here again, I am reminded of a couplet which I would share with you. The couplet says, "Jo khairat mein milti kamyabi to har shakhs कामयाब होता, जो खैरात में मिलती कामयाबी तो हर शख्स और ना ही कोई शख्स धीरज जी जैसा लाजवाब होता. If you have to do something, you have to work in tandem with that. You have to create the value and worth to perform. So ladies and gentlemen, I want to just tell you that we need to work in order to be at the highest step. Taking a clue from professional opportunities, I would like to share that in the coming days, opportunities are shrinking. Audit is again in a great flux. GST audit has gone. Tax audit now have a greater impetus with terms of the cash withdrawals. Banks have now merged and there are lesser banks and lesser branches which can be audited. So at this time, internal audit is an area which is the most upcoming, most sunrise area. And you can use this to create value and worth not only for yourselves, but for your clients, your stakeholders, regulators, and government as well. Moving ahead, what are some other areas which I would like to share with you? Always prompt you to have better perspectives and greener pastures. First area, important area, no firms will exist without having so many things to see. Now when you have to file technology expertise in source, you want to always use technology. You speak of artificial intelligence, blockchains, you speak of Internet of Things to inculcate as a practice firm to create value and worth in times to come. The second area is outsourcing. Please understand the relevance of internal audit is because now transactions are being held across borders. What is the importance? What is the use of cross-border transactions? The reason being that now we have localized, specialized knowledge. And I want to very candidly tell, because Mr. Makhijani is from Gurgaon, you'll be happy to know that Gurgaon now has been adjudged as the best destination. Even Dheeraj is from Gurgaon. The best destination where outsourcing work is done internationally. It is now a historic fact. The number of outsourcing clients and assignments in Gurgaon are greatest in the world. We are at number 1. So ladies and gentlemen, when this country becomes the back office of outsourcing, we chartered accountants should become the back office of all accounting activities. It would be great honor bestowed upon us. So now just to conclude, I would like to just share a small PPT with you and discuss some issues on section 195, just for put my PPT. Is my PPT visible?
Yes, sir. Yes.
Great. So I will just, this is a very big PPT. I will just take 2-3 slides which I feel are pertinent to give the discussion of this session a great impetus, and that discussions can be resonated in times to come. What are the basics of withholding tax for non-resident? You need to understand the development of tax, withholding tax, which is in India known as TDS. There is a lot of historic perspective to it, and this will be taken by the faculty only. Now, withholding tax provisions applicable to NRs under the Income Tax Act 1961. This is again a question of lot of discussion, scope, trigger point, presumptive tax, issues on non-resident and non-resident transactions call for a lot of indulgence and lot of clarity. Role of DTAA and MLI in determining withholding tax. Now I would like to just spend some time on development of withholding tax concepts in India. What is the historical perspective? The background. The purpose and objective of this profession, of this provision, essentially, largely is to allow source data, the source state to retain tax before making remittances to the resident state. It is very important where the working is done, where the transaction is effected. This is, however, subject to various taxing provision as well as treaties between various countries. Very importantly, it is all subject to treaties between the various countries. The fundamental principle, which is accepted right from Income Tax Act 1922 onwards, is that tax should be withheld as preliminary deduction and not the final determination of tax payable. The ultimate tax payable shall be when the assessment be made, and then you have to determine the incidence of tax. Withholding tax has to be based on what is liability of non-resident in the source state. Very, very important. It has to be deducted in the source state where that transaction has been effected. DTAA decides in which state and in what manner should it be taxed. In the source state or a resident state. Very important. The incident, so the incidence of tax depends on various. With least cost of collection over in India, it is known as TDS, whereas internationally it is known as withholding tax. Now,
Nanda sir, some disturbance in your voice, Nanda sir.
नंदा सर आपकी आवाज नहीं आ रही. हेलो.
He is in travel, so there is a network issue, I think.
आप धीरज भाई, आप एक बार नंदा सर को कॉल करोगे क्या?
जी जी जी, मैं 1-to-1 बात करता हूं.
Participants, please bear with us for a couple of minutes. We'll just get him back.
Anshul sir, Nanda sir will be rejoining us.
ठीक है I think
हाँ,
वो rejoin
yes,
कर लेंगे
sir.
तो ठीक है
हाँ, सर ने rejoin किया. Yes sir.
Am I
please.
audible?
yes sir
हाँ,
now
yes sir. Yes.
So,
Sir,
so just I would like to conclude. I would like to conclude by saying that the work done by your Diwali e-learning is fantabulous because it puts newer professional opportunities to chartered accountants and internal audit coupled with international tax would be a great area where you can venture because international taxation litigation cases are now subject to internal audit also. So I suggest that all of us can use this opportunity to create value and worth, not in servicing your clients, but for yourself also. This technical topic and this workshop, which has been done in a phased manner on a daily basis, shall put you at a parlous where you start understanding international tax and more importantly, the importance of international tax as an integral part of your daily practice. I want to thank you all, but at the time when I say goodbye to you, I want to tell you one thing. It is your strength which is important. As chartered accountants, we have to drive our thought process from Swami Vivekananda. A person asked Swamiji, he says, Swamiji, you have gone through Veda and Upanishads n numbers of times. Can you tell me in a line the gist of Veda and Upanishads? Swamiji smiled and said, my boy, in a line, I shall not only tell you the gist of Veda and Upanishads, I will tell you the entire concept on which India thrives. The words uttered by Swamiji are written in golden words in Indian history. He said, strength is life and weakness is death. This doesn't mean that tomorrow, Monday morning, you hit the gym and start making your body. It is the strength here, Zehni Takat. And the best part is that people who are strong always embrace strong people, and people who are weak look for weaker destinations. कुछ इस कदर बदहवास हुए आंधियों से हम, कुछ इस कदर बदहवास हुए आंधियों से हम कि उन पेड़ों से लिपट गए जो खुद ही खोखले थे. My parting note that when you have to do something technical, be strong. Let your technical skills be at the highest level. Let your knowledge, your inputs, your indulgence be at the highest level. I want to thank Dheeraj Sharma ji for inviting me. I am thankful to the battery of learned speakers and Madam Palak who have led this entire course to a very beautiful conclusion. They say difficult roads lead to beautiful destinations. So now we are coming to the end of today's session and then today's course at the end of the day. So I want all members to draw more. Thanks a lot.
Thank you, sir. We thank you a lot for taking out time and guiding us professionals in terms of various aspects of profession. And also, there is one query, sir. You mentioned that we can now partner with lawyers and CS. So the query is
yes,
whether
you can.
Bar Council has approved this. Bar Council has approved the lawyers to partner with us or not. Whether there is a restriction.
I want to tell you. So now these are two different perspectives. For example, you are a chartered accountant. I am a lawyer. So you are governed by your own institute. I am governed by the Bar Council. So both of us joining, there is no issue. There is an issue Bar Council had was when I, as a chartered accountant holding a COP and I'm a lawyer as well, I wanted to take a advocate practice license, which was not allowed. So here, if I keep an employee as a lawyer as an employee, also there is no issue. So in such case, there is no issue on collaboration. The rules are being framed at the institute, and with the regulator doing it now, Ministry of Corporate Affairs doing it, Ministry of Law has its concurrence to it, so there is no such issue.
Okay,
great.
great.
But still, even today, you are a chartered accountant, and you may be an LLB, but you can't take both the degrees together. Your COP of CA and membership of Bar is not allowed.
Yes. That's quite clear.
Great.
Thank you, sir. Thank you very much. Dheeraj ji, do you want to say some words?
Sir, thanks a lot, Nanda sir. Thank you, sir.
Most welcome.
Yeah,
Yeah,
it's really always
Bye-bye.
pleasure to have you, sir.
Dollars entirely mine, sir. Prizes entirely mine. Thank you. Bye-bye. I take your leave.
Thanks a lot, sir. Now we are proceeding for our today's session. So our speaker is Anshul Singhal, sir. I request you, sir, kindly proceed with the today's topics to carry forward from the where the Nanda sir has stopped his deliberation. Over to you, Anshul, sir, please.
Sure. So I hope my screen is visible now. Dheeraj, my screen is visible?
Yes, sir. Yes, perfect. Perfect, sir.
So now we will start the deliberation in greater detail on section 195 and form 15 CACB. And as Charanjot Singh Nandaji was saying, that section 195 is predominantly in order, has been brought in to cater to the interest of the source country as in India, where the transactions are taking place. But the foreign party is not under the jurisdiction of Indian government. So in terms of collection of tax, it is very important to have such provisions. Now we will go and see what are the basic overview of legal provisions regarding section 195 and some other relevant provisions in the rules as well in the sections which must be noted and taken care of while dealing with international transactions. And then we will also see what are the kind of form 15CA, different parts of form 15CA, when they are filed, when they are not filed. And then we will move on to the case studies where we will see what are the practical issues we face generally while issuing form 15CA and CB. So that is how we will proceed into this session. So what is the basic provision? So first of all, the foremost section is 195, which talks about the withholding tax while making payments or credit or to a non-resident entity. And it talks about that in what circumstances tax need to be deducted. Then there is section 271I, 206AA. In rules, you will see 37BB, 37BC, 21AB, and in the forms we see form 15CACB, and we'll now see all these rules and sections in greater detail later in the slides. So first of all, we start with section 195 and subsection 1. So 195 subsection 1 is the base provision wherein we have to come back again and again and see whether a transaction is liable to withholding tax or not when we are dealing with a cross-border transaction. So let's read the section first. It says any person responsible for paying, means first of all, if you would notice, it says any person responsible for paying to a non-resident, not being a company, or to a foreign company, any interest, not being interest referred to in section 194 LB and or section LC or section 194 LD, or any other sum chargeable under the provisions of this act. So this is important. Any other sum chargeable under the provisions of this act, not being income chargeable under the head salaries. So salaries is not covered. If you have employed any foreign resident as an employee of the Indian company and you are making a payment of salary, salary will not get covered under 194. It will keep on getting taxed the withholding tax will be required to be deducted as per section 192 itself. Shall at the time of credit of such income to the account of payee or at the time of payment thereof in cash or by issue of check or draft or by any other mode whichever is earlier deduct income tax thereon at the rates in force. So we'll discuss the greater aspects of this particular section in the coming slide, but let's move on and see what are the other subsections of 195. Section 195.2 talks about application of payer to an assessing officer for determination of lower withholding tax. Means when I am making the payment, that the Indian party making the payment to a foreign resident, then as a payer I can go to tax officer and obtain a lower withholding tax certificates. Mainly if a foreign company is operating in India through a permanent establishment and I have to deduct tax at the rate of 40%, then most of the times we have to claim deduction of expenses. In those circumstances, as a payer, I do not know how to assess the taxable income, and therefore I go to the tax officer and say that please estimate, this is the estimate, you see it, and if you are fine with it, issue me a lower withholding tax certificate. Similarly, in terms of section 195.3, the recipient, basically the foreign party, can also approach the income tax officer and obtain a nil withholding tax certificate. Section 195(4) talks about validity of the certificate, this lower TDS certificate. Subsection 5 talks about powers of CBDT to issue notification. Subsection 6 is the important section which governs the provision related to filing of Form 15 CACB and furnishing of information related to the payments to foreign residents. And we will see in greater detail in the coming slides. Then 195(7) says authority of board to specify class of person or classes to make application under section 195(2). Therein some banks and some other classes of recipients have been classified under this particular subsection. And then subsection 271I, this is very important subsection because it talks about the penalty of rupees 1 lakh if proper information is not furnished in relation to international transaction. And what is the information? Information which is required to be furnished in Form 15CA and 15CB. So therefore, if there is any discrepancy in filing of Form 15CA, there might be an invocation of section 271I in order to levy a penalty of 1 lakh rupees. So therefore, it becomes an important aspect to understand that in what circumstances and when Form 15CA and what kind of information is required to be furnished therein. Now, what is the objective of section 195? As Nandaji also said, that tax is collected at the earliest point of time, because when we are dealing with the non-resident party, we don't know whether they will come to India back again or how we'll catch hold of them if they do not pay the appropriate taxes. Therefore, the responsibility has been cast upon, and a stringent responsibility has been cast upon the Indian payer to withhold taxes. Second, there is no difficulty in collection at the time of assessment. Third, to avoid loss of revenue, as non-resident may not have assets in India from which subsequent recovery can be made. And these objectives were pointed out in circular number 152 dated 27th November 1974. So you see that this provision is an old provision and almost 50 years ago provision, which was introduced in order to cater to the interests of revenue. Now we'll see that we had read section 195 subsection 1. So these are the components of subsection 1. What it says is payer. What is payer? So if you would see, it says any person responsible for paying. If you would notice that in other section 194J, 194C, it says person resident, right? So it also classifies certain exceptions in terms of individual or HUF which are not liable to tax audit, or the threshold of turnover has not crossed the limit which is liable to tax audit. So those exceptions, none of those exceptions has been provided in this particular section, and therefore even if an individual is making a payment to a non-resident party, and if that sum is chargeable to tax in India, the individual person is liable to withhold tax. Some of the very common transactions which come into notice is payment of rent to an NRI owner of the house, or payment of consideration, sale consideration for purchasing a property from NRI. In both these circumstances, the individual person who is either a tenant or the purchaser of the property is under an obligation to withhold tax, and for withholding tax, the TAN number is also allowed. So when we are purchasing a property, the 1% TDS we generally apply in resident to resident transaction is not applicable, and we have to obtain TAN and deduct proper TDS of 20% or 30%, whatever is applicable in the case of NRI, means adjudicating whatever the transaction is, whether it is a short-term capital gain, long-term capital gain, we need to see and determine the tax rate accordingly, right? And second point, it says it includes non-resident, whether or not such non-resident has a presence in India. So whether means we are not concerned with the physical presence of non-resident in India, which means that even if a non-resident is making a payment to another non-resident, please understand that we are talking about payer. So if a non-resident is making a payment to another non-resident, say for example, a transaction is of shares pertaining to an Indian company, shares issued by an Indian company to say company A in Mauritius. Now company A in Mauritius is selling those shares to company B in US. The US company will be making a payment to company A in Mauritius. In that particular circumstances, company B used to take a plea that I do not have any nexus with the Indian jurisdiction. I am just purchasing a share. So why should I be involved? This is a classic Vodafone example, wherein Vodafone purchased shares from Hutch and did not deduct tax. So this amendment was made, and it was said that if the transaction is chargeable to tax in India, even a non-resident will be under an obligation to withhold tax, and we are not bothered about whether the non-resident is having a presence in India or not, right? So therefore, the first component is payer. The second component is a non-resident being a company means the payee. Now we will see who is the payee. So first payee is non-resident not being a company, and second is a foreign company. So can anybody tell me that why this distinction is made? Why the foreign company was not covered in the non-resident aspect itself? If you could just let me know in the chat box. Anybody who's willing to answer? Okay, so I'll answer. A foreign company is located outside of India. A foreign company can also become a resident. How? By virtue of application of place of effective management. If a foreign company is having a place of effective management in India, it will become a resident entity for Indian tax purposes. But when you are making a payment to a foreign company, the Indian government does not want the loss of revenue at the initial stage, because ultimately, even if it becomes a resident entity, the control of Indian government is much lesser on that particular foreign company having jurisdiction in a foreign location. So therefore, they have carved out foreign company as a separate entity, and they are not bothered about the residential status of that foreign company. So even if a foreign company is a resident, when you are making a payment to such company, withholding tax will be applicable under section 195(1) if the transaction is chargeable to tax in India. And more so, if the entity is a resident, it becomes a resident entity as per POEM, the global income will become taxable. So in such cases, there will definitely be a liability to withhold taxes. Now moving on to the third component, it is the nature of payment. What is the nature of payment? It says interest or any other sum chargeable to tax, and it excludes payment of 194 LB, LC or LD. So these are basically any sum which is chargeable to tax in India, and it excludes salary also. And the fourth and the last component is TDS. When the TDS is required to be deducted. TDS is required to be deducted at the time of payment or credit, whichever is earlier. This is very simple. We deal it day in, day out. Whenever we have booked an entry in the books of accounts, or we have made the payment, whichever is earlier, TDS is required to be deducted. And at what rate? At rates in force, only if sum payable is chargeable to tax in India. So this has now been decided, as we discussed in yesterday's session also. There are plethora of judgments in GE and in Samsung, in many other cases, wherein it has been ruled that withholding will only apply if the transaction is chargeable to tax in India. If it is not chargeable to tax, income tax officer cannot just come and say, you are making a payment, so you are under an obligation to withhold tax. No, it comes with a rider. The obligation of withholding tax comes with a rider that first of all, it must be chargeable to tax in India. Say for example, if we are purchasing goods and it is not liable to, the foreign company is not having any permanent establishment in India. So in that particular circumstances, we may not be under an obligation to withhold tax, because it is a simpliciter transaction. Even though if the purchase has been made from digital source, equalization levy may apply, but that is a separate aspect. We are not under an obligation to withhold tax under section 195 subsection 1. Now when we have moved on that deduction is liable or not liable, we have seen it under section 195 subsection 1. We come directly to subsection 6, which talks about furnishing of information in relation to this kind of transactions. So what does 195(6) says? It says the person responsible for paying to a non-resident, not being a company or to a foreign company, if you would see similar wordings are there, any sum, whether or not chargeable under the provisions of this act. So if you would carefully see that withholding tax would apply only if the sum is chargeable to tax, but the furnishing of income is required and has been mandated whether or not the sum is chargeable to tax. That means even if I am making a payment to an international party and a foreign resident, and if such sum is not chargeable to tax, as a payer I might be required to furnish the relevant information in relevant forms if it is prescribed, right? There are certain exclusions, we will see those exclusions, but there is no such criteria that only when the transaction is chargeable to tax, I will be required to furnish the information. What are the other components of 95(6)? That information has to be furnished by the payer. The pay is not under an obligation. I, as an Indian party, making a payment from India, is under an obligation to furnish this information. Also, if you would see, the information has to be furnished at the time of payment, because what is the information? Information is information relating to payment of such sum. So until and unless the payment is happening, what is the information we will submit? So at the time of credit, this is a big practical challenge, because many times when you have deducted tax at a particular time of credit, say for example, you have credited this sum on 31st of March of a particular year, and you are making a payment in April. So what will you do? The TDS has already been deducted on 31st of March. So the exchange rate might differ, because at the time of payment, the exchange rate might be something else, and you might withhold some extra sum or lesser sum. You might be required to do that, but there can be some mismatch, and therefore we generally suggest that income mismatches should be avoided at the most. But yes, this is a practical challenge which we have to keep in mind while booking such payments. Third thing is, filing may be required even if payment is not chargeable to tax. Say for example, there is no deemed accrual of income in India. Say for example, you are making a payment of fee for technical services or royalty, where we see yesterday that income is not chargeable to tax in India, either by way of availing the make available clause in the treaty, or by virtue of certain other services which do not get covered under the definition as provided under the Indian Income Tax Act or under the treaty. So in those circumstances also, a form 15 CA might be required to be filed, and relevant information might be required to be furnished. Income is accrued in India but has been specifically exempted, expressly exempted, right? Income that enjoys treaty exemption. So we all need to see and determine whether the sum is chargeable to tax or not, and even if it is not chargeable to tax, we might be under an obligation to file form 15 CA. Then the filing has to be in the prescribed form. Prescribed form, I am saying form 15 CA, and it has been prescribed under rule 37 BB, capital B. So what is income tax rule BB says? It defines the manner to furnish information in form 15 CB and making declaration in form 15 CA. So basically, what are the circumstances in which form 15 CA and CB has to be filed are prescribed under rule 37 BB. We'll see in more detail in the next slide that what are those parts and how and when we need to file it. But first of all, we need to understand that what is the objective of filing form 15 CA and form 15 CB. So this provision was introduced in Finance Act 2015, and in the memorandum explaining Finance Act 2015, it was mentioned that there are twin objectives of getting these filings done. First is ensuring deduction of tax. So first and foremost is that you have deducted tax, and when we are filing, we'll have to mention whether we have deducted tax or not, and therefore the information gets accumulated with the revenue authorities to acknowledge and see whether there has been a particular compliance done or not. And in the very latest policy draft, which has been opened up in 2021 along with the Finance Act 2021, it has been announced that at least 25% of Form 15CA CBs filed with the income tax authorities will be scrutinized, means will be verified. And you would have seen in the last 15-20 days, there have been many issues of notices under section 133(6), wherein the income tax department, TDS department has asked for queries relating to Form 15CA CBs. So therefore, it is important to see and to very carefully file all these forms, because as on date, the Indian government is very much focused and they are looking to analyze all these transactions with greater eye and greater detail. So Form 15CA, it's simple. Although the word CA is written, but it is not to be filed by a chartered accountant, it is to be filed by the taxpayer. But the Form 15CB is to be filed by a chartered accountant, means it is to be issued by a chartered accountant along with UTIN. Form 15CA and CBs are required to be filed electronically, and Form 15CA is split in 4 parts. There are 4 parts of Form 15CA. First part is Part A, which is required to be filed if payment is chargeable to tax, but the payment during the year to a particular party does not exceed 5 lakh rupees. In this particular case, you have to file Form 15CA Part A only. And there is no requirement to file Form 15CB or get a certificate from a chartered accountant in Form 15CB. In Part B, you have to see that payment is chargeable to tax. Also, the payment is greater than 5 lakh rupees, but a lower TDS certificate has been obtained from the assessing officer. In that particular case, you have to file Part B, where, so you can see that payment is more than 5 lakh rupees and lower TDS certificate has been obtained from the assessing officer. In that particular case, Part B is required, only Part B is required. Again, Form 15CB is not required, because ultimately the rate and the quantum of income has already been determined on an estimate basis by the assessing officer itself. So therefore, there is no requirement to obtain Form 15CB. Now coming on to Part C. Part C is the main form which we generally see to be filed when a Form 15CB has been issued. Here, the payment is chargeable to tax, and the total amount of payment expected to be made during the year to a particular single party also exceeds 5 lakh rupees, and there is no lower TDS certificate which has been obtained from assessing officer. In that case, Form 15CB from a chartered accountant needs to be issued, and along with that, Part C of Form 15CA needs to be filed with the income tax authorities. And Part D is very simple. When the payment is not chargeable to tax at all, it is a blanket form which needs to be filed even for all the payments which are not chargeable to tax, and there is no requirement of obtaining Form 15CB in this particular case. Although there are a few exceptions which have been provided in the Income Tax Act to reduce the compliance burden, but as a matter of fact and as a legal precedence, almost all transactions are required to be reported. In 15CB, we have already discussed, it is a form which needs to be issued by chartered accountant. It is only required when the Part C of Form 15CA is to be filed, and it is also required to be furnished electronically. So I'll just mention that there has been a little change in the process how we file Form 15CA CB. Earlier, we used to file in the old income tax portal. The chartered accountant used to file the Form 15CB first. The taxpayer used to accept it and then file Form 15CA. And then the matter was over. But now Form 15CA needs to be filled up first. And also the chartered accountant needs to be assigned, which the CA in his own professional login on the income tax portal needs to accept that, yes, I have been appointed and I am accepting this appointment. After the Form 15CA has been filed, Form 15CB needs to be filed by the chartered accountant using his own digital signatures, and then it will again go back to the taxpayer, and then the taxpayer will accept the Form 15CB. only then the process will be completed. Although I have not practically filed up any Form 15 CACB as of now, because the site has been very tormenting, and we have been struggling to deal with this particular website. I'll not go into those details as of now, but this is what I've learned from my professional colleagues and also with a few people who are dealing with these kind of transactions. So this is the process. Means the process has become a little lengthy. First Form 15 CA, assignment of chartered accountant, then filing of Form 15 CB, and then again acceptance from taxpayer. Now, what are the exceptions? So remittance by individual under liberalized remittance scheme, and there is a list of 33 specified items which has been provided under Rule 37 BB3, which are exempted from filing of Form 15 CA Part D also, because when you are making a payment under liberalized remittance scheme, you see that you will either travel outside of India, or your family member or your someone is undergoing medical treatment or education and you want to remit funds for maintenance purposes. In those circumstances, these are not taxable transactions, and also these are on of personal nature. Therefore, to reduce the compliance burden on individual taxpayers, such kind liberalized remittance scheme, please be mindful of that it is applicable only on individuals making remittance abroad. The $2 lakh, $2.5 lakh per year of limit, which is applicable under the liberalized remittance scheme. So that scheme under current account transaction, you are exempt, and the list of 33 items also. This is the list of 33 items which is mentioned under Rule 37 BB sub Rule 3. First of all, you would see that Indian investment abroad in equity shares. So if you are making a capital investment in some foreign company, here you would see first item. Then you would see advance payment against imports, payment towards imports, settlement of invoice. This is the major thing when the goods are imported and we do not need to file any Form 15 CACB. Earlier, when the Form 15 CACB were introduced, initially, these exemptions were not there. And at that point of time, it had become a very big controversy that when we are importing goods, we need to file Form 15 CA or not. And at some organizations were filing. Means that was very big challenge, and to avoid such kind of compliance burden, this list of 33 items was prescribed. So you would see if your remittance towards donations to charitable or religious institutions abroad, this is also exempt. Refunds or rebates, the 32 item, refunds or rebate or reduction in invoice value on account of exports. So say for example, if you had issued an invoice, you had made an export, and the quality was not good, or you had to give a discount or credit note, and you are remitting the money back to the foreign customer. In those circumstances also, you are not required to file any form 15C or CB. Right. So now we have seen that there are four parts of Form 15CA which needs to be filed, but there are different conditions when we will need to file each of the forms. So we'll just try to understand from a simple flow chart that how we need to determine that. So first of all, we need to ask a question whether the payment which we are making is chargeable to tax in India or not. And if the answer is yes, the next question will be whether the amount is greater than 5 lakh rupees or not. If the amount is not greater than 5 lakh rupees, you would probably have to file only Part A of Form 15CA. No Form 15CB is required. But if the answer is yes, you have to ask another question, whether a lower TDS certificate has been obtained from the income tax authority. And if the answer is yes, you'll have to file Part B. And if the answer is no, you'll have to file Form 15CA Part C along with Form 15CB. But we'll go back to first question, whether the payment was chargeable to tax, and the answer is no, then what? We'll have to see whether this transaction is specifically covered under the exclusions of Rule 37 BB, or it is a liberalized remittance scheme payment. And if the answer is yes, we'll say no form is required to be furnished. But if we say that no, it is not covered under the exclusions, then we'll have to file Part D. But without any Form 15 CB. So this is the summary flowchart which can help you determine which part of Form 15 CA needs to be filed. Now there are a couple of queries. I can just take them one by one. Please guide in which circumstances we have to approach AO to determine tax liability. Himanshu ji, this is a very common thing. If you, as I mentioned, in terms of permanent establishment, a foreign company is having a permanent establishment in India, and if you are making a payment, so means if you have not obtained a lower TDS certificate, you don't know what kind of expenditure they are making. So you will have to deduct a 40% tax rate on the entire payment, because a permanent establishment is chargeable to tax at the rate of 40%. A foreign company on business income is chargeable to tax at the rate of 40% plus surcharge and cess. So in those circumstances, if you want to make the deduct TDS at a lower rate, you will approach the income tax authority. Similarly, say for example, if you are purchasing a property from a non-resident NRI, and there are a lot of cost, means there is a cost which has been paid by the NRI to purchase that property. As a payer, you are not authorized to judge what was the cost, or you are not even able, even if it is very, very clear. In the law, there is no provision for you to calculate the amount of capital gain which is liable to tax, because section 195(1) clearly says that if any sum is chargeable to tax, then you have to deduct tax on the whole of such sum, right? So there have been few rulings in the past which say that if some part of the sum is also chargeable to tax, then as a payer you need to withhold tax at the rate tax on the entire payment. So in order to determine the capital gains liable to tax in a particular transaction, you can approach an assessing officer. So these are the basic and very common examples where we go and approach the assessing officer. Then the another question is, why interest is mentioned separately in the nature of payment when it is also mentioned any other sum chargeable to tax in India? Sir, interest is separately mentioned because there are two exceptions of interest. So it might be just because to clarify that these interest payments are to be excluded, and therefore interest payment is, because frankly speaking, I'm not aware about the intention. For equalization levy, whether Form 15CA, Form 15CB is required for such payment. Sir, as of now, to my mind, Form 15CA CB is still required, but you will say that equalization, I have not dealt with this particular practical scenario, so we'll need to see about it, and I can come back to you later on the WhatsApp group. If a foreign company repatriates its funds to own account outside India, whether Form 15CA CB is applicable. Sir, we'll talk about one case study, similar kind of case study, and we'll answer this. Suppose I'm going to pay foreign supplier for engineering services for whole FY. So with reference with that, how we make 15 CB? Is it quarterly basis for whole FY as on the date of TDS of whole FY? What is more relevant? Please advise. If we go quarterly basis, then there will be 4 certificates. But if we go date of TDS deduction for whole FY, sir, I have mentioned in my earlier slide that the filing of Form 15 CA or CB is at the time of payment. So it is not at the time of credit in the books of accounts, because you have to furnish the details related to the payment only. So if you are crediting, say for example, retainership fees on each month at the end of each month, but you are making a quarterly payment, so Form 15C and CB are required to be filed only on a quarterly basis when you are making the payment, not at the time of credit, right? If Indian company pays sales commission to foreign entity for export of sale, then whether it can be considered as income deemed to accrue in India for deduction of Section 195. Sir, export commission is, there are now plethora of judgments which say that export commission is not chargeable to tax in India. So in that circumstance, you can just file Form Part D, Form 15CA Part D, not chargeable to tax. In case of dividend payment to NR, payments made to Indian bank and payments made to Indian bank. Arpit ji, your query is not clear. In case of dividend to NR and payments made to Indian bank, FA 15, are these two separate payments? Are you talking about two separate payments? So dividend to NR and payments to Indian bank, this is something which I have already covered in the coming case studies, which we will discuss in some time. So dividend, as you know, you will know now that from financial year 2021, dividend payment is now taxable in the hands of shareholders. So it is a sum chargeable to tax now. It is not exempt. Now let's move on and see some of the other section which says that 206AA, it is an important section that when the foreign company does not have a PAN in India, so what should we do? Because 206AA is very clear that whenever a party, a payee does not have a PAN, the tax shall be deducted at the higher of the following rates. What are the rates? At the rate specified in the relevant provision of the Act, or at the rates in force, or at the rate of 20%. So at the rate specified in the Act and rates in force, I'll just give you an example that what can be the different thing. The rate specified, say for example, in last year, rate specified in Act for 194J was 10%, but for a majority part of the year last in financial year 2021, the rate in force was 7.5% because of a notification which was issued by the CBDT, wherein 25% of TDS was reduced in almost every section. So in those particular circumstances, the rate in force can be different from the rate specified in the provision of the Act. So it can also be a case in 195 wherein the rates can be different depending upon the circumstances, and 20% or 20%. So whichever rate is higher. So for example, if you are making a payment of fee for technical services, which is chargeable to tax at the rate of 10%, but the foreign company does not furnishes a PAN number, the rate of tax will become 20%. So there was a big challenge, and in earlier years of introduction of section 206AA, when it was introduced in 2009, till many years there was no exception, and the payers were under an obligation to withhold tax at the rate of higher percent of 20% of rate in absence of PAN of a foreign party. And many times at that point of time, the payment was net of tax. So ultimately the burden of making the tax payment or the withholding tax was on the Indian party. So to avoid that, certain exceptions were provided, which we will discuss. But moving on, there is also one more section which has been introduced from this Finance Act, which is section 206AB, which also talks about a panel kind of a withholding tax in terms of if the payee has not filed his tax returns for past 2 years, and if the tax deducted at source is more than 50,000 in each year. So in those circumstances, the higher TDS rate is required to be deducted. So I will just ask one simple question, whether this particular provision of 206AB, it is just a general knowledge question, whether it is also applicable, it can be applied on payments made to non-residents. So just if you can answer in chat box, yes or no, a simple yes or no. No. Xavier ji says no. Any other person who says, means can we apply 206AB? Because we'll need to see then the application of 206AB. No, but it depends. Tarun Nohani says it depends. Where P? Himanshu ji says where P? No. Harish Mangla says no. Yes, if it has P. Devesh ji says yes, if it has P. Yes, very well said. It is not a blanket no. It says the proviso to section 206AB subsection 3 says that provided the specified person shall not include a non-resident who does not have a PE in India. So in other terms, only a non-resident having a PE in India shall be subjected to section 206AB, provisions of section 206AB. So whenever you are dealing with a PE, a permanent establishment, say for example a branch office of a foreign company in India, In those circumstances, you also need to see the applicability of section 206AB and not just 206AA. Also, whether section 206AB applies to a foreign company. Now we had discussed the difference between foreign company and a non-resident. So what do you say? Can it apply to foreign company if it qualifies as a resident? Yes. Ramkrishan ji says yes. No. Vishnu Gupta ji says no. Yes. How we know the filing of ITR of foreign company? Manish Joshi ji says yes. So the answer is yes, it can apply. The exclusion is only for non-resident, and it is not for a foreign company. And to answer that, how we can know the filing of ITR of foreign company, there is a utility which has been provided by the Income Tax Department on Insights portal of GOV, wherein you can register your TAN number on that website, and then you can check all the PAN numbers you are having. There is a facility of bulk upload also, and you can just upload bulk PAN numbers in an Excel file on that utility, and it will throw up. It takes some time, a few hours of time to revert back. If you are uploading in bulk, then it takes some time and gives you a list against all the PAN numbers, whether it is a particular PAN is specified person or not. And it also, this same utility also gives you an answer whether the PAN number of an individual taxpayer is linked with his Aadhaar card or not, right? So there is another section which has come up now, which says that if PAN is not linked with Aadhaar, you will be required to treat the PAN as invalid. And then if the PAN becomes invalid, section 206AA will apply. So this utility is very much useful. We have been using it now, and it throws up. So you need not do anything. Earlier, when this utility was not there in June, a lot of companies were sending emails on emails and asking for declaration whether you are a specified person under the terms of section 206AB or not. All that has been done away with. All the things have been clarified by way of clarifications issued by the CBDT, wherein it has also been mentioned that this particular activity of verifying the PAN needs to be done only at the beginning of the year only, or when you are doing the first transaction. So it is not required to be updated. Means, say for example, if 1 year income tax return has to be filed in September, so after that filing, it needs not to be rechecked again on that utility. So the topic will deviate more. So I'll come back to section 195 and cross-border transactions. I will focus on that. So coming back, 206AB can apply to a foreign company if by virtue of place of effective management that company has become a resident in India. Now you saw that in 206AA there is an onerous requirement on the foreign company to obtain a PAN number. But there is an exception which has been provided in Rule 37BC, which says that in case a non-resident, not being a company or a foreign company, and not having a permanent account number in provisions of section 206AA shall not apply. The provisions of section 206AA shall not apply in respect of payments in nature of interest, royalty, fee for technical services, dividend, and payments on transfer of any capital asset if the deductee furnishes the details and documents specified in sub-rule 2. So what you will interestingly see is that this particular exemption apply to certain nature of transactions: interest, royalty, fee for technical services, dividends, and payment on transfer of capital asset. This does not apply to business profits. So if someone is earning business profits, and business profits, when can it be taxed in India? When the sum will be chargeable to tax in India? When the foreign company has a PE in India. So in those particular circumstances, the government says that if you are having a permanent establishment in India, or if you are coming from a non-treaty company and you are taxable by virtue of having a business connection in India, you are required to obtain a PAN, and we will not allow you to escape and earn business profits from India without having a PAN number. So we need you to be under the control of Indian tax authorities, and therefore the payer is not allowed to apply these exemptions on business income, payment of business income. Now, what are the documents specified in Rule 2? Rule 2 says the deductee in sub-rule 1 shall furnish in respect of payments. What are the things? This is basically the information which is captured in Form 10F also. Name, email ID and contact number, address in the country or specified territory, certificate of his being resident, the tax residence certificate which we need to obtain from a non-resident party, and the tax identification number. And in such case where this tax identification number is not applicable, any other number by which that particular government recognizes the enterprise or the entity or the individual, there might be some other number which has been issued by the government of that particular country or territory, that need to be quoted in Form 10F. Until and unless all these documents are made available by the foreign party, you cannot give exemption under Rule 37 BC. So I think there are a few queries. If Indian company pays sales commission to foreign entity for export, whether it can be, I think that this is I have already answered. TDS on guarantee commission to foreign company to be covered under section 195. Sir, this is a very typical question. If you would see, there is a case of Johnson's Method by Delhi Tribunal, and therein the guarantee commission has been held to be taxable as other income, right? So when it is chargeable to tax in India, the Form 15CA and withholding tax will also apply. Withholding tax may apply because many a times it need to be seen whether the guarantee commission which we are paying to the foreign parent company, generally it is the parent company who is providing guarantees on behalf of subsidiary companies to either Indian banks or to foreign banks for obtaining loans. In those particular circumstances, we need to see that whether the foreign parent company is in the business of providing guarantees. So what happens mainly from Japan, you would see that the parent companies are providing guarantees to almost every subsidiary company in their group. So in those particular circumstances, you can obtain a confirmation from the parent company that whether they are declaring the guarantee income as part of their normal business profits in their home country, or how they are classifying it in their books of accounts, or offering it to tax in their home country. So until and unless these facts are explored, it cannot be said that it is a business income and would not, this plea cannot be taken that this is a business income not chargeable to tax in absence of a PE. So Johnson's Method case is a late, I think 2 or 3 years old case, wherein it has been held that guarantee commission is other income. So we need to be careful by, and also please mind that most of the chartered accountants I have seen, they issue Form 15CB considering the guarantee commission as interest income. Please mind that guarantee commission is not interest income at all, because guarantee commission is being paid to an entity who has not provided you debt. Interest is only against debt. It can only accrue to party who has provided you loan. Until and unless there is a loan flowing from the entity, the payment of guarantee commission cannot be classified as interest payment, right? So either it would be 0% tax, you would say that this is a business income not chargeable to tax in absence of P, or you would say that this is another other income, this is in the nature of other income chargeable to tax under the provisions of domestic tax law, and the rate applicable is 40% plus applicable surcharge and cess. Therefore, we need to be very, very careful. In case of 206AA, whether DTA will prevail or 206 will override, sir, there are a few case laws which have mentioned, which have held that DTAA will override, that when the amount is itself not chargeable to tax, then probably we can always take a plea that the 206AA does not apply. Also, a few judgments have also held that once the rate of TDS has been prescribed under the DTAA, 206AA cannot override it. But in my personal view, I believe that there, as we also discussed in first session of overview of overall tax structure, the tax treaty, there can be circumstances which can be provided in the Income Tax Act to override the provisions of treaty. So if you would see, sir, in section 206AA, it starts with notwithstanding anything contained in any other provision of this act. So when it says any other provision of this act, this also overrides the provision of section 90, by virtue of which DTAA has come into force. So until and unless DTAA comes into force and it has overridden all those provisions, to my personal belief, 206 does override DTAA, and DTAA should not prevail. But yes, as on date, there are a few judgments which say that yes, DTAA can be taken benefit of at the time of application of withholding tax also. So now, sir, we will move on to procedure. This is basic procedure, how the steps which we can take in order to make a foreign remittance. First of all, make a classification of the transaction. As we have discussed in last 3 days, we have also we have tried to see and understand whether transaction becomes taxable as a business income by virtue of a permanent establishment, or it is a royalty payment, or it is a fee for technical services, or it can be interest, dividend, capital gain transaction. Whatever is the nature, first of all, we need to classify whether it is chargeable to tax in India under the provisions of Income Tax Act, as well as read with the DTAA. Once this classification is being made, you also need to obtain certain documents to verify the nature of transaction. What are those documents? You need to obtain the copies of invoices, contracts, the communication which may have happened between the taxpayer and the foreign party, the PAN number of the foreign party if it is available, or tax residency certificate, which is in any case required whenever you are making a payment. The information to be filled up in Form 10F, no PE certificate from the foreign party, foreign exchange rate as on date we are issuing the forms, Form 15CA and CB. All these documents and information is very much relevant while you are making the foreign remittance. Then you would see that the amount which the transaction which you are dealing with, whether it is covered under the exceptions or not. If it is not covered under the exceptions, you will also see whether it is chargeable to tax, the applicability of DTAA. You will also see whether there is a nil withholding or a lower TDS certificate which has been obtained from the assessing officer. Then if it is not obtained and the amount is chargeable to tax, you will see the applicability of filing of Form 15CB. And if it is required, you will file it electronically. And also, the taxpayer will need to file the relevant Form 15CA and the relevant part thereof. Either it can be part A, B, C, or D, which we have already discussed in earlier slides. So whatever is the relevant part of Form 15CA, that needs to be filed. And that is how we'll complete the entire transaction. So this is it for the procedures, and we'll now move on. We can have a little break, Dheerajji, if you would say. I think now we'll have just case studies to discuss. We can have just 5 minutes of break.
Yes, sir, we can have 5 minutes break, and if any member who don't want to take break, they can put their questions in the chat box or Q&A section.
Yes, in the meantime, I can just answer I can take some few more questions. There is one question from Manish Joshi. There are conflicting judgments on interest on income tax refund in case of non-resident having PE, whether it's to be characterized as interest income or business amount. Any views? Sir, my personal view is that if it is an interest, because it is a debt owed by the income tax department. So if it is an interest owned, means if it is something which is a liability of financial liability which the income tax department owes to the taxpayer, and they are withholding the amount, and by virtue of that withholding they need to pay me, compensate me for that duration of time period for which they have withheld my monies with themselves. Actually, this is a compensation for time for which they have not paid me. So this is in the nature of interest only. To my mind, this is in the nature of interest, and this cannot classify as business income. To my mind, this is not a business income, although they are conflicting judgments. But to my mind, it should be considered as interest income only, and tax should be paid at the concessional rate of 20% as provided in the Act, or if it is under the DTAA, we need to see whatever interest is provided in that article, right, which is dealing with the interest income. Then we have, hope any foreign payment towards reimbursement of expenses not subject to TDS. Hope any payment towards reimbursement. Yes, sir. If it is reimbursement, very clearly documented by backup documents, which says, but you need to be mindful of GAR also now. And if you see that a particular transaction has been structured in a way that it was the responsibility of the Indian company to avail the services, and the services are also such which were liable to tax in India. But just to avoid the withholding tax in India, you have inserted or interjected an associated enterprise by saying that you make the payment first to a foreign party, and I'll make a payment to you by saying that this is a reimbursement of expense. Then probably it might be a difficult scenario. However, there are many other cases where the parent company takes an umbrella contract, say for example of Microsoft Office operating software. The parent company will take a contract or licenses for the entire group of companies operating all over the world. In those circumstances, it is a commercial business transaction to avail price effectiveness, price efficiencies, and to coordinate with the service provided in an efficient manner. So therefore, in those particular circumstances, even though the transaction was also not chargeable to tax in India, and when I am making a payment as a reimbursement of expense, then probably I'm free to take a plea that it is not chargeable to tax in India, right? Business income. Yes, Maniji, I think I have already taken up and given my views on interest on income tax refund. I think in chat box also there is one question from Manish Joshi ji, which says Rule 37 BC applies to dividend also after amendment. Yes, sir, dividend is there. Dividend I already mentioned. So Dheeraj ji, should we start now with the case studies?
Yeah. Yes, sir, I think so. Please.
Great. So, so friends, I would like your involvement in the case studies because these are practical examples which we face day in, day out. I will be presenting some facts, and I'll be raising some queries. And this is all in respect of when we need to file Form 15CA or when we need to file Form 15CB. So this is something to do with practical instances. So first, which we see very often, that the transfer of shares of an Indian company is taking place, and the facts are a US company had acquired shares in an Indian company in March 2020, right? In November 2020, the US company sells part of such shares to another non-resident UK entity for the same price. Means, say for example, if the shares were purchased in 1 crore rupees in March 2020, it is being sold in November 2020 at the same price, say for example, 1 crore rupees itself. And obviously, if the shares are being sold at the same price, there will be no capital gain. Even 1 year term is not exceeding, has not exceeded for the shares to be held by the non-resident US company. Therefore, the transaction is classifying as short-term capital gain, but the amount of capital gain is zero because whatever was the purchase cost is the sale price also. So by calculation, the amount is zero. Then what we need to do? What is the requirement of filing Form 15CA, CB in view of provision of Section 195 read with Rule 37BB, even if the transaction is not resulting in any capital gain. So please take care that there is no capital gain which is arising in this particular transaction. Now, whether we need to file something, and if yes, which part we need to file. So I would just like you to answer in yes or no, and if yes, which part to be filed. Part CB CA required, part B is required. Sir, part B में तो CB required ही नहीं होता, part C में required होता है CB. If the transaction exceeds 5 lakh rupees, then 15 CB also. Then part C will be required to be filed of 15 CA. Part C is required to be filed. Part B or C. Part C. Part C is required. So the participants are saying that even if it is not resulting in any capital gain, part C is still required to be filed. Right? So what my views are in this particular transaction, in regard of this transaction, is that 195.6 read with Rule 37BB requires reporting of any payment made to an NR irrespective of its chargeability to tax. So for example, we had read and we have seen that 195.1 withholding tax might be required on a sum chargeable to tax, but 195.6 is very clear. It is not relevant that whether the sum is chargeable to tax in India or not, right? But in this particular circumstance, the sum is chargeable to tax, although the computation is resulting in nil income. So what it says, while part C of Form 15CA is full-fledged form format requiring elaborate details like provisions of the Act under which payment is taxable, part D is a simple self-declaration which applies where payments are not chargeable to tax under the Act. Part B is required to be filed where lower TDS certificate has been obtained. So part B is very clear. If the parties have already approached income tax authorities and have obtained lower TDS certificate by showcasing that yes, see, whatever was the purchase cost is also the sale price, so there is no withholding tax applicable, and the assessing officer has issued a lower TDS certificate, the thing is over. Part B and done. But we are discussing when this is not applicable, when the lower TDS certificate has not been obtained. Then what? Technically, compliance is required even if payments are not chargeable to tax in India. In the present case, the transaction is chargeable to tax, yet the final amount is such that it does not result in any taxability or tax liability. So in this particular case, the sum is chargeable to tax, but sale consideration which you are remitting is chargeable to tax, although the final amount of tax liability is zero. So please see, means this is a very minute difference. Chargeability does not mean that there should be some tax liability which must arise. Chargeability can be there even though the final result of computation is nil. Say for example, if the profits of a permanent establishment are being computed, so permanent establishment's profits are chargeable to tax, but if the profits are negative, in that case tax liability might not arise, right? But the payment will be chargeable to tax. It may be arguable that since there is no income taxable in India, as there is no capital gain tax liability, hence part D should be applicable. However, considering the transaction itself is chargeable to tax, it would be prudent to obtain a lower TDS certificate from the AO. Because why I have written this, many chartered accountants I have seen, some of the big fours also taking this position, that when the computation of income results in a nil tax liability, they just either file Form 15 CA Part D, or they just file Form 15CA Part C along with the certificate in Form 15 CB from a chartered accountant, saying that the computation, we have done the computation and the income tax is zero. To my mind, that is not a correct position to take. Tax authorities have already taken a stand, means we keep on dealing with certain circumstances and the tax authorities, and tax authorities are very clear. They if they come across such kind of transactions, they are going to issue notices. They are going to call the taxpayer and hold accountable that why you have not withheld tax and why did you not approach the income tax officer for obtaining a lower withholding tax certificate. So as per income tax authorities, a chartered accountant is capable, means is allowed to determine the tax rate which is applicable, but is not capable or is not authorized legally to determine the amount of income which is liable to tax, right? So there is a difference which the income tax authorities say that as per form 15 CB, you are only required to determine the tax rate which is applicable on a particular transaction, and you cannot sit in the chair of the assessing officer and also assess the income which should be liable to tax. So therefore, there is a provision to go and apply lower TDS certificate which should be taken recourse to. And also income tax officers are initiating penalty provisions because wrong information or according to them incorrect information has been furnished, or even if the wrong part has been furnished. So therefore, we should be mindful while dealing with such transactions. Now coming to case study 2. Case study 2 is a simple, means I think in one of the questions it was asked in earlier in the session, when we are making a payment to a foreign branch of an Indian company. So you would come across that many PSU or Indian banks, ICICI Bank, HDFC, SBI, they have foreign branches across Singapore, Mauritius, USA, UK. They have their own foreign branches. And if I am dealing here in India with State Bank of India, I generally prefer to deal with the branches in the overseas jurisdiction also. So say for example, if an Indian company has imported goods from an entity in Hong Kong, and the Indian company obtained funding, say for example, traders or buyers credit from the Singapore branch of ABC Bank in India, which is, we'll call it ABC Singapore branch. And now the Indian company is making a payment of interest on the buyer's credit to ABC Singapore. So what should be the tax means what should be the applicability of Form 15 CACB? Whether we are required to file a Form 15 CACB in this particular case or not. So I would love to hear in the chat box. Yes, Tarunji says yes. Ramkrishnji says yes. Form 15 CB is required. Yes, 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 yes. There is an overwhelming yes. Yes, Form 15 CA and CB required. Manish ji, Pramod ji, Harish ji, Tarun ji, Ramakrishnan ji, Arijit Das ji says Form 15 CB is also required. Xavier ji also says yes. Rajesh Khatri ji also says yes. So let me give my views. What are my views in this particular transaction? Where ABC Singapore is regarded to be a branch of ABC India, the payment made to ABC Singapore will be treated at par with payments being made to an Indian bank, which is a resident entity in India. So a foreign branch of an Indian bank does not classify as a non-resident. So when we had seen the provisions of section 195(6), it said payment being made to non-resident. See here, any person, the person responsible for paying to a non-resident, here it says, is non-resident, or to a foreign company. Now, when we are talking about a branch, a foreign branch of an Indian bank, it is neither a non-resident nor a foreign company. Right? So foreign branch of an Indian bank is regarded to be an extension of Indian bank itself and not a separate foreign entity. when the payment is being made to a resident, no compliance under section 195(6) is required. Legally, there is no requirement to file it. Although you may face a practical challenge because the payment is going outside of India, the Indian bank may insist to file certain form. But legally, we are not required to file any form, because we can very well say that the provision, the legal provision of section 195(6) does not apply at all. Right? So therefore, we must confront the banks if they are insisting. I do understand that there can be some practical challenges, but yes, we have to confront. As professionals, we have to toe the right path, and as per law, as per provisions of section 195(6), a legal compliance of filing form 15 CACB is not at all required when I'm making a payment of interest to foreign branch of an Indian bank, right? Now let's move on to case study 3, payment of rent to a non-resident owner, right? So we all see many cases where the NRI is the owner of a property and we take the premises on rent from them. It can be a residential house, it can be a commercial property. And say, for example, if the rent per month for the property is 50,000 and the rent and the premises has been rented for the entire year. So for example, the payment is going to be 6 lakh rupees per year. So whether form 15 CA and CB compliance is required for payment of rent made by person A, the tenant, what do you have to say? Whether it is required or not? Yes, no, yes, no, yes. No from Haridwar branch. Manish Joshi ji says yes. Ramakrishna ji says yes. Galaxy Note 10. Galaxy Note 10 says no. Akash Shokeen says yes, required. Yes, because payment is being made to non-resident. If payment is made in INR, then no. Geeta ji says no. Vishnu Gupta ji says form 15 CACB both required. Yes, form 15 CA part C along with form 15 CB. Yes, yes. Niket ji says no. But if same is transferred outside India, then yes. Arpit says yes. Arijit ji says reimbursement of expenses not required. Reimbursement of expenses? Why, sir? Why it is reimbursement of expenses? This is rent payment. I'm making a payment of rent. Ashish Chitora ji says yes. No if payment made in NRE account. NRE account. NRE is foreign exchange account. Yes, if payment in India not required. Parshav says if payment in India not required. So let's understand what are the provisions. Rent is chargeable to tax in the hands of non-resident owner, right? This is we all agree. The amount of payment exceeds 5 lakh rupees during the financial year. Yes, we agree, 50,000 per month. The amount will be 6 lakh rupees. In those circumstances, Part C of Form 15 CA should be filed along with Form 15 CB, or Part B of Form 15 CA should be filed if lower TDS certificate has been obtained from the AO. Now, why no form should be filed? There is no reason that no form should be filed. To my mind, there is no logical reason of escaping this requirement. You'll also have to undertake or obtain a TAN number, the tax deduction account number, and you'll also have to file regular TDS returns in such case, right? So there is no escapement of filing Form 15 CACB in these circumstances when the non-resident owner is earning a payment of 6 lakh rupees during 1 year. So we had understood the entire graph, entire chart. So when the payment is chargeable to tax, if the payment exceeds 5 lakh rupees, and if no TDS certificate has been obtained, Part C is required to be filed along with Form 15CB. If lower TDS certificate is obtained, Part B is required. So this is very clear. Also, I would just like to mention that I think rent was not an income which was mentioned in Rule 37 BC, right? So when if the non-resident owner does not have a PAN in India, you will have to see the applicability of Section 206AA, right? In any case, on rent, the TDS is required to be deducted at 30% flat generally, because there is no lower tax rate which has been provided in the Income Tax Act or the treaty. Generally, Article 6 of treaty which deals with immovable property says that the tax is to be deducted as per the domestic tax laws. And in the domestic tax laws, for a person who is a non-resident earning rental income, it is generally treated as other income, and therefore it should be taxed as per the maximum marginal rate. So as a payer, I would in any case require to withhold tax at the rate of 30% plus surcharge and cess. And therefore, even though technically 206AA comes into picture, but because the rate itself is higher, rate applicable on this transaction is higher, it would not make much of a difference. Right. I think this case study is also clear. We'll move on to the next one. Also, there was one valid point made in many of the comments that when we are making a payment to an Indian bank account, this is a practical challenge. So what we discussed right now is a thing which is legally applicable, but yes, when you are making a payment to NRO account, please mind, NRE account is still a foreign, generally considered as a foreign account, and even if payment is being made from NRO to NRE account, generally the banks ask for the TDS, this Form 15 CACB. We'll discuss one of the case studies in this particular regard also. But yes, when you are making a payment to the NRO account, there is a practical challenge, performance, impossibility of performance, that when you are not remitting the money outside of India, you cannot file Form 15 CACB, and therefore you need to document this particular transaction. You need to document this particular fact that you are making a remittance to the payer in the Indian bank account, and therefore Form 15 CACB cannot be filed in the present form because it does not allow me to enter the details of an Indian bank account, right? We have to take into account the foreign exchange, because when I have entered into a rent agreement in Indian currency, I am making a payment in the Indian currency in Indian bank account. Practically it is impossible, right? So although legally it is required, practical challenge may arise. But in any case, if you are making remittance outside of India, then there is no question. You have to file Form 15 CA, Part B or Part C, whatever the case may be. Now, case study 4, we will discuss how we see limit of 5 lakh rupees. Say, for example, in the facts of a case, an Indian company makes payment of export commission to various parties. Say, for example, party A in country US, party B in UK, party C in Japan, party D in Mauritius. They are all helping you out in exporting of goods in those particular locations, and you are making a payment of export commission. The amount of export commission payable to each party is less than 5 lakh rupees. Say, for example, company A 2 lakh rupees, company B 3 lakh rupees, company C 4 lakh rupees, company D 5 lakh rupees, or 4.5 lakh rupees. So in each of the case, the amount payable is less than 5 lakh rupees. But if you would see the nature of transaction of export commission from a payer's standpoint, I am making an export commission payment of more than 5 lakh rupees. So what should now be done? Whether there is any, or probably we can just replace the export commission with some amount which is chargeable to tax, right? You can also consider it both ways. First case scenario, export commission, and also you can consider a situation where I am making a payment of fee for technical services, right, to different parties. Then let's say for export commission, what should be first case scenario, export commission, what should be the requirement of filing? Form 15 CA or CB. Five lakh is per year per person. Hence, only Form 15 CA has to be filed. Form 15 CA. No. Form 15 CA. Sir, if Form 15 CA is to be filed, which part? Please also let me know which part. Part A. Tarun Nuhani ji says Part A. Ramakrishnan ji says Form 15 CA. Vishnu Gupta ji says Part A. Part D. Arpit ji says Part D. When is Part D applicable? Part A. Ramakrishna ji says Part A. Sir, as of now, we are talking about export commission. Export commission. Manish Joshi ji says Part A. Part A. Galaxy Note 10. Part A. Manish Kumar Jindal ji says Part A, Form 15 CA to be filed. Part D of Form 15 CA. Parshav Jain says Part D of Form 15 CA. Now let's see. Rule 37 BB1 provides the person responsible for paying to a non-resident, not being a company or a foreign company, any sum chargeable under the provisions of the Act shall furnish the following, namely. And what is that? An argument can be taken that Rule 37 BB applies to each payee separately rather than on an aggregate basis. Why? Because it says a non-resident and the person responsible for paying to a non-resident or to a foreign company. So when the rule provides the terminology a non-resident or a foreign company, then we have to see each payee, each recipient of income as independent party, and the aggregate threshold needs to be seen per party basis and not in the aggregate nature of income. So the person means this requirement is not linked to the nature of income but is linked to the payee. So the threshold of 5 lakh needs to be taken and tested qua a payee and not in aggregate for all the transactions. Export commission is generally considered as an amount not chargeable to tax in India, and thus Part D of Form 15 CA can be filed for each transaction with no requirement of Form 15 CB. So I think I am very clear. We had discussed in earlier slides, Part A is only required to be filed when the transaction is chargeable to tax in India and the amount does not exceed 5 lakh rupees. So therefore, when we are dealing with export commission, Part D can be filed. And in the second scenario, which I mentioned, that if it is a fee for technical services liable to tax, in that circumstance, you can file Part A. Right? In both the cases, Form 15 CB is not required. Right, sir? And then we come to the last case study, which is the most common transaction which we encounter when a non-resident NRI is transferring funds from one bank account to a foreign bank account or to NRE account. What should be done? Here, first of all, we will discuss to a foreign bank account, means not within India, but the transaction is happening, means he is taking out money to a foreign bank. A person A wishes to transfer funds from his bank account in India to his bank account in foreign country. Whether Form 15 CA and CB is required for such transaction, right? So I would like to hear from all of you. What are your views? Part D, Form 15 CA required. Arijit ji says Part D. No, sir. Surendra ji says, Sujanendra ji says no. Yes, Form 15 CA, Part D. Xavier ji says Part D. R. Singhvi ji says, DR Singhvi ji says no, not required. Manish Kumar Jindal ji says Part D, Form 15 CA to be filed. No. Arpit ji says no. Galaxy Note 10 says no. Ramakrishnan ji says, no, it comes in the exemption. Rule 37 BB. Exemption. Okay. Specific exclusion. No form 15C, 15CA and CB. Part A 15CA. Part A. Okay. It may depend upon purpose of remittance. No payment to payment OT, not ANR. Payment from resident to resident. No, sorry, it's not resident, it's non-resident. Transfer of funds from non-resident. So payment is from by a non-resident, from his bank account to a foreign bank account. So payment is being made to a non-resident. Not required, not being, no, being LRS payment. Part D 15CA. Part D 15CA. Chanchal Singh ji is saying no being LRS payment. And Haridwar branch says part D form 15CA. So let's see what's the answer. Sir, first of all, tell me to whom liberalized remittance scheme applies. Does it apply to a non-resident or to a resident? Liberalized remittance scheme applies to only a resident. When a person has become a non-resident, he is out of the purview of liberalized remittance scheme. There is a separate scheme for non-resident Indians who are settled abroad, wherein the limit of remitting the surplus funds or the amounts or the sale proceeds is $1 million per year. This is a separate scheme. This is not covered under liberalized remittance scheme. So first and foremost, liberalized remittance scheme only applies to resident individuals and not to non-resident. We'll discuss the difference if NR is a company or an individual. If a company remitting funds to its wholly owned subsidiary. Sir, abhi we are talking about the same entity. The non-resident is same. Non-resident is transacting with himself, right? So first of all, please be clear, this transaction is not covered under liberalized remittance scheme. Very, very clear, no doubt about it. Answer is remittance from one account to another account of same person is payment to self, which is outside the scope of withholding tax under the Act. Because when you are making a payment to self, you cannot withhold tax from self until and unless there is a permanent establishment or something like that. Because in that particular scenario also, there is a practical challenge that whose PAN number you should mention. The deductee is also same and the deductor is also the same. If the permanent establishment is making a payment to a non-resident head office, then also it becomes some challenge. But here, as of now, we are talking about an individual, right? So an individual, which is a self entity, and let's take an example that he had surplus funds in his bank account in India, and now the amount is being remitted to his own bank account. So when the payment is being made to self, legally the provisions of withholding tax do not apply. On similar lines, compliance under section 195(6) read with rule 37BB is required in respect of payments made by any person to a non-resident. that is the scheme of this language of these provisions envisage existence of two different persons when a person is making a payment to a non-resident, right? So therefore, payment to self, to my mind, are not covered. The language of section 195(6) read with rule 37BB, which reads as follows, which says person responsible for paying to a non-resident not being a company or to a foreign company supports the view that compliance is arguably attracted when the payment is made by one person to another. Consequently, it is not attracted when there is remittance from one account of individual to another account of outside India of the same individual. So this is my view, that if an individual is transferring funds, there is no requirement to furnish any form, either form 15CA, part A, part D, part B, part C, part or 15CB. To my mind, there is no such requirement. Legally, it is not required. And in fact, Even in the case of transfer of funds from NRO to NRE account within India, most of the banks insist that there has to be a Form 15CB issued. In fact, I'm currently dealing with one such issue where an Indian bank is insisting that you must issue Form 15CB, and we have highlighted the provisions that Part D is applicable, at least at the most, even if you are requiring of compliance, a Part D of Form 15CA, which is a self-declaration, is sufficient because this amount is not chargeable to tax in India. So where is the requirement to file Form 15CB? Because we see constantly an argument by citing certain internal circulars that bank says that we have an internal guideline that we will require Form 15CA. So as professionals, we must take a stand, we must stand up, although we also need to consider the interests of the assessee, but at least some discussion must take place. It should not be accepted as such that we are filing Form 15CB even though it is not legally required, right? And many banks, we have seen in practical circumstances, many banks ask that, okay, if you are not issuing Form 15CB, please give us a certificate on your letterhead, just stating in a form of letter, stating that the funds which are being remitted from NRO bank account are surplus funds on which tax has already been paid in earlier years, right? So in fact, that particular letter may suffice because that is something which the bank is asking for. But issuance of Form 15CB in these particular circumstances, to my mind, should not be done because that is a legal form which you are issuing. Therefore, to my mind, considering specific language of the provision, the payments under both the cases are not covered within the ambit of reporting of Form 15C or CB under Rule 37BB. However, there are practical challenges may arise where we have already discussed. Banks do insist, and we should discuss this with the bankers. Also, in terms of making payment by a permanent establishment in India to its head office, this is also payment to self. So legally speaking, in my view, filing of Form 15 CACB should not arise. However, in any case, if it arises, because the payment is being made from permanent establishment to its head office, and permanent establishment is already chargeable to tax in India for all its profits, a Part D can be issued and can be filed by the permanent establishment. But it would be, to my mind, it's only just a compliance which needs to be done. There is no legal requirement because we are making payment to the self. As per the provisions of 195 subsection 6, it is very clear, the language is very clear that existence of two persons is required. Although there is a deeming fiction for tax liability, computation of tax liability, that these two persons have to be treated as separate persons, but that is only for a fiction created for the computation of tax liability. But while we are talking about section 195(6), there is no such fiction created in this particular provision. There is no proviso, there is no explicit mention that if a permanent establishment is making a payment to head office, or if, say for example, Indian company is making a payment to a permanent establishment outside of India, in that case also we are not making a payment to non-resident, because if there is a permanent establishment of my entity in India in a foreign jurisdiction, and if I am making a payment to that permanent establishment, even though it is an international transaction, but I am not making a payment to the non-resident entity. So all these circumstances need to be taken care of. There can be other examples. There can be a long list of examples, but today we had to discuss these case studies, 5 case studies, which generally gives you a flavor of how to deal with the practical situations. And I'll just give you a brief overview of what are the practical challenges while we deal with these transactions. Is whenever we ask for a tax residency certificate, it might not be available, but should be done. There is one case law which has come right now, I think in December 2020, which said that even if there is no tax residency certificate applicable, the taxpayer cannot be obliged to follow this because this is an onerous rule. And if by virtue of all other facts and circumstances, say for example, by virtue of their legal documentation, their citizenship, or the incorporation of that company in a foreign jurisdiction, it is proved that the foreign entity is a resident of foreign country, then just merely by not having a tax residency certificate will not be an impediment, right? So, but this is only one of case. As on date, as a professional, we must insist, and we should not just get lenient depending upon just one ruling. So non-availability of tax residency certificate is one of the biggest issues. And the TRC is issued in foreign languages many a time. In that particular case, you must ask for an official English translation from an official translator of that country, from that country. If the TRC does not pertain to the year in which the payment is being made or accrued. So when we are making a payment, many times the foreign company provides us the tax residency certificate of earlier years. So we should insist that you please provide us the tax residency certificate belonging to the particular year. There can be some overlap. Say, for example, if we are talking about financial year starting from April to March, but in foreign country, there can be a tax year of calendar year. So if they provide to current calendar year, we should be fine with it. Difficulty in obtaining TRC from countries which do not have income tax laws, say for example, Middle East. But in recent times, the UAE and other countries have also understood the importance of tax residency certificate, and their Ministry of Home Affairs have started issuing. So we have obtained a couple of them from Ministry of Home Affairs. So it is a time-taking process, but it generally gets, means we get a TRC from these countries also. Transfer of funds from NRO to NRE account. This is one of the biggest practical challenges which we have already discussed. So we must discuss with the banks and see how to resolve this. International transactions made through credit cards. So for example, if it is a business expenditure, but the shareholder or the director makes the payment through credit cards and then claim a reimbursement from the company, we generally recommend to the companies that if you are incurring significant expenses, please do not incur expenses in foreign jurisdiction through credit cards. Means, say for example, if you are taking a subscription, you make a payment through credit card, then how would you file Form 15 CACB? Even if it is not chargeable to tax, you are required. Say for example, if it is a company and if a director has made a payment of online subscription, you are required to file Form 15 CA Part D, at least, even if it is not chargeable to tax in India, right? So these kind of transactions must be considered, and the clients must be made aware that how to deal with certain situation. Payments made while on a tour outside India. So we dealt with this particular example that a shooting company, a advertisement shooting company or a film shooting company went abroad in some Europe jurisdiction. There they had to make the payments to artists or to the event company which was managing the particular shooting. They had to make the payments there. Now it is a foreign exchange which you have taken from India to make such payments, but ultimately you have made an international transaction, and Form 15 CACB is legally required to be filed. So you need to also consider that how these are practically possible to file these kind of Form 15 CACB, and at least even if you are not able to file, because generally post facto, once you have already made the payment, you even don't know what kind of payment will be required to be made while you go for shooting a picture abroad, because generally you hire people as and when it is required in foreign jurisdiction. So you can probably document that there was impossibility of performance in kind of certain transactions which were involved, or you can say that, or you can take a blanket transaction. You can make a blanket transaction with an event management company in a foreign country, and you can just ask them to raise an invoice, therefore make a payment through proper banking channels. Also, one of the cases, one of the other challenges which arises here is that if you have taken foreign currency in cash and you make payment to artists in cash on a daily basis there, you need to see whether the payment was made more than 20,000 in a particular day or not, because many times it may happen in euro, in foreign currency, per day wage may also exceed 20,000 rupees. So in that case, the disallowances of cash transaction should also be considered, although it is different from 195, but the disallowances must also be kept in mind. So these are some of the other practical challenges which we generally face while dealing with cross-border transactions. and some have answer, some do not have answer, but we have to deal with it, we have to live with it. This is how we go about handling international transactions. So this is the case law which I was mentioning, SCAPS Industries India Private Limited. It is an Ahmedabad tribunal ruling which says that tax residence certificate is not mandatory to claim treaty benefits if tax residency can be proved on the basis of some other evidences. So this is also, I've mentioned it for your reference purposes in this particular slide. And this is it from my side. Today is the last day, so we have concluded a bit early. I would like to have, if you have any queries, I would like to answer them. Let's see in the Q&A section if we have any query. Hope any foreign payment towards reimbursement is not subject to TDS. I think we had already discussed it. Branch office of foreign company transferring fund from Indian bank account to themselves outside of India. Sir, I think this has also been covered already in my discussion earlier. What about expenses incurred by foreign branch of Indian company? Sir, expenses by foreign branch of Indian company. Sir, foreign branch now is already located outside of India, right? So technically speaking, the provisions may apply, but again, the impossibility of performance is there because you have already might have invested money while you're remitting funds to your branch. Probably at that point of time itself, banks may argue and may insist upon filing of certain certain form 15 CA, even though part D. So once a compliance has already been made at that point of time, then again branch making expenses does not in any case require any further compliance. Also, if a foreign branch is located outside of India and if it is making expenses from there only, then the payment is not going from India. Ultimately, Form 15 CACB are structured as such that it applies only when the payment is moving out of India, right? You have to mention foreign exchange rate, the bank account details of the receiving bank and party name and everything. So therefore, it can also be considered as an impossibility of performance whenever the P or the branch of an Indian company located outside India is making an expense. So we can, very safely say that no such filings are required in this particular circumstances. Arijit ji says, yes, AD banks do insist on filing of certain forms. Yes, sir, we do understand that this is a problem. And I think problem is with the framing of law as well. The banks are being conservative, and if they don't have a Form 15 CACB, the revenue authorities are more stringent on them because there are certain gray areas. As I mentioned that when a non-resident individual is transferring funds from Indian bank account to a foreign bank account, as on date, the provisions of law are not worded as such that it covers this kind of transaction, but the intention is to cover such kind of transaction. The government, I think the intention is such because they have framed the form in such a manner, but the provisions of law do not support it. As I said that there are some answers available to questions, some questions do remain unanswered, and that is where professional judgment needs to be taken and the matter needs to be decided accordingly. So that is it from my side. Dheeraj ji, are you there?
Yes, sir. Yes, sir. Yes, sir. Perfect. So you have completed, sir, your deliberation. Members, if you have any other question, though I believe that maximum of the questions have already been answered by you, sir, during the session. Even question asked in the chat box and a question in the Q&A section as well. If any member feels that any question is unanswered or any other question, additional question you would like to ask, kindly ask Anshul, sir.
I think we will stay connected on the WhatsApp group. There are a few people who are raising hands. So because we have some time, so let us allow them to, with
Yes,
your
sir.
permission,
Yes,
Dheeraj ji.
Yes, sir. I am unmuting one by one. So first,
Please.
Nishaji, you raised your hand. I am asking you to unmute. You can unmute yourself, Nishaji, please. I am allowing to Mr. Javier, sir.
Anji.
Yeah, Mr. Javier, yes, sir, you can unmute yourself. I think there may be hand raised by mistake as well. Yeah, Mr.
Can just
Panda.
ask each one. Panchanana Pandaji.
Yeah, Panda, sir, please. Sir, you can.
Pandaji, if you have any
actually, this is
Yeah,
Panda. I really thankful to the organizer, and I think this is a very useful move, and we should continue it in future as well. So thank you all. It's a very useful. Today's session is very useful for our day-to-day activities actually.
Thank you very much, sir. And with your participation, we definitely have enjoyed deliberating all these topics. And I think I had announced yesterday also, and I'll announce today again, with the permission of Dheeraj ji, that
yes, sir. Yes, sir.
we are proposing, and we are in the process of finalizing 2 more series of webinars. First on transfer pricing, which will be a 3 to 4 days of series, wherein we will deliberate on various aspects of transfer pricing, be it when is transfer pricing applicable, so the basic principles of recognizing which transactions are covered under transfer pricing. And even domestic transactions are sometimes, even if you are not dealing with non-resident, domestic transactions are also covered. Not the specified domestic transactions, which was earlier there in the Act. There are certain other domestic transactions which are covered under transfer pricing, such as it is international transaction. So what are those kind of application of transfer pricing? What are the various forms which are need to be filed? There are so many forms now in transfer pricing, form 3CEB, form 3CEAC, 3CEAA, so many forms to be filed. So we'll discuss what are the implication of each of the form, when it is required to be formed, by which company it is required to be formed, what are the due dates of filing such forms, right? Then we'll discuss how to do benchmarking. Actual problem of transfer pricing is that we don't know how to do benchmarking, even if we understand that the principles and the basic economic analysis, but we don't know how to use the databases, the capital line, the prowess, how benchmarking is done. So we'll deliberate, have one session on that also. How to write transfer pricing reports, transfer pricing study, how to prepare documentation, right? What are the burning issues in transfer pricing these days? What are the important issues which need to be considered? So all these type of sessions we are in the process of finalizing the sessions and the speakers for this particular series, and we'll come up with this series very, very soon. I think within a couple of weeks. And another series we are going to have on level 2 of international tax, because this was very basic level of international taxation, where we will deal with permanent establishment, royalty, fee for technical services, and overall structure. The second level, the level 2, will deal with certain complex issues on international taxation, which is equalization levy. What is the impact of equalization levy? How we consider most favored nation clause? How do we read it? What are the implications of most favored nation clause on the taxation of particular incomes? Generally, it is on fee for technical services and royalty. How can we save taxes by using these clauses? What is the how do we take foreign tax credit? How do we eliminate foreign double taxation? What is the article dealing with it, right? What are the implications of multilateral instrument, which has been signed by India a few years back? So how the treaties have undergone change, because many of the provisions which we read and which we understood are the basic provisions, but some of the provisions have undergone a change from multilateral instrument. What are the BEP section plans, different BEP section plan, and how they are impacting the tax treaties? And the last, the global minimum tax rate, which has been announced by G20 countries, and wherein 130 countries have already signed to it. What are the announcements which have already been made, the press release of Indian government, and what is the overview and how it is going to impact tax structures of multinational companies in future? So this is going to be the level 2 international tax course, which we are also going to launch in some time. So we'll hope that all of you will again participate in those series and gain from the knowledge of learned speakers, which we will be arranging and finalizing in some time.
Yeah,
So
transfer pricing. Actually, transfer pricing is very complicated thing. Actually, it will be very useful if we discuss in great detail. It will be useful for all the participants. I think it will be great. This move and ideas actually.
absolutely, sir.
Thank you.
Absolutely.
Thank you, Anshulji. Thank you.
Thank you, sir. Sir, there is one Shama Galaji. I think उन्होंने भी hand raise किया है.
Yes, sir. I'm allowing her also to speak. Shamaji, you can unmute yourself. You would like to ask any question.
नहीं, उन्होंने hand down कर लिया. I think वो mistake से था.
Yeah.
So I think we can proceed, Dheeraj ji, we can proceed to
Yeah.
conclude the
Sir,
discourse.
one more member, Ramakrishnan ji raised his hand.
हाँ जी, please.
Ramakrishnan sir, you can unmute yourself now, please.
At the outset, let me thank both Dheeraj ji and Anshul ji. It was an excellent session. Many of the concepts got cleared in this. I have one question. See, there is always this thing about this TRC or a PE declaration. Now, suppose if the income is not taxable in India, do we still insist on a TRC or only a PE declaration will do?
Sir, how would you say that income is not taxable in India?
Now, certain things we know like export commission and things like that, which are already.
Sir, if it is export commission and you are exempting it under the Income Tax Act itself, and you are not taking any benefit, then probably you can say that income is not chargeable to tax itself, right? So TRC might not be even relevant.
No, but how will we know the non-resident can be still be a resident in India, no? Unless we have the TRC? How can we conclude that? Because if he is a resident, then TDS will come, no?
Yes. So in that particular scenario, see, that is why TRC is required. But generally what we say, we consider the basic documents and we consider the basic facts of a particular transaction. And if we for sure know that we have not dealt with any representative of the foreign entity in India, right? Or we have not dealt with any agent of foreign company or an employee who is present in India, and we have always dealt with the foreign employees of the foreign company for doing foreign export commission. In terms of those transactions, it would neither classify as business income, because the business of export, even though they might have any office or any permanent establishment in India, that particular income is not connected with that PE as on date, as per the circumstances and facts available to us. Or in terms of fee for technical services, as we had discussed yesterday, this transaction is for business which is being carried out by me outside of India. Or in all those circumstances, it is not chargeable to tax. So when it is not chargeable to tax itself, there is no question of section 206AA arising.
Okay. Thank
right?
you.
So when 206AA does not arise, then we do not need to go to 37BC also.
Yeah. So thank you. We look forward to more such sessions from you. Really enjoyed being with all of you.
Thank you, sir. Thank you very much. And I will request all the participants to stay in touch through the WhatsApp group. So please be there, because we will always be sharing thoughts and views, and we will be gaining from each other's experiences. For example, last night, Manish Joshi ji updated me on Hebbel's case. It was a welcome thing. It updated my knowledge also. So it is a mutual enriching program. There is nothing like that speakers are more knowledgeable or participants are not. It is a mutual process wherein we are helping each other to grow.
Absolutely, sir. Right. Perfect. And indeed, it's a pleasure to be in connect with every one of you, all the intellectuals, all the professionals who are part of that group. So sharing your own experience or on knowledge, that can create a good knowledge for all of us as well. So thanks a lot, everyone. Anshul sir, if you permit, so can we conclude it at now?
Yes, sir. Yes, sir.
Yeah.
I think if there are other queries, we can take it in the WhatsApp group.
Yeah. Anybody have any other query? We can take in the WhatsApp group. those who are not part of that WhatsApp group, I have shared the joining link in the chat box as well. Still, if somebody is not able to join that particular WhatsApp group from this link, so I would add them personally in the WhatsApp group. Now we are concluding the 4 days learning series on international taxation. In the 4 days, the learned speakers shared their experience, shared their thoughts with us, and with the help of all the participants and with the help of the view given by the participants, the question asked by the participants, and the suggestions made by the participants, we have learned a lot, and it was the mutually a growth prospective session. So I am really very much thankful to every one of you on behalf of all the 3 organizations, Asian Economic Council, Let's Share, and Chamber of Chartered Professionals. All these 3 are non-profit motive entities. So on behalf of all these 3 organizers, I take this opportunity to convey thanks to all the speakers, thanks to our course director Anshul Singhal ji, and thanks to all the participants. Thank you very much. Kindly stay tuned, and we should not stop our learning. Let's share. Thank you.
Yes. Thank you. Thank you, Dheeraj ji. Thank you very much.
Thank you. Jai Hind. Thank you.
Jai Hind.